All attendees are in listen-only mode.
Good morning, everyone. I'm Karandeep Manhas from ICICI Prudential AMC, and I'm part of the ETF team here at the ICICI Prudential AMC. I welcome you all today to this call, which we have arranged for a launch of a very unique product and a product which we are going to discuss today. Um, just to give you a little bit of a background, first of all, I would like to thank HDFC Securities for giving us this platform to interact with all of you. And as I was saying, that we are going to discuss a very unique product, which is called the ICICI Prudential Nifty 200 Momentum 30 ETF and Index Fund. So even though the name is quite long, but actually, if you look at this product, it is quite a simple product. One of the factors in the market which is looked at very closely, and one of the most important factors is momentum. Simply put, momentum is something where the market is actually heading to, right? Which is probably the recent trend, to put it in simple words. Now, this is one of the most important factors, as I said, and these kind of funds are actually called the smart beta funds. So ICICI Prudential AMC takes a lot of pride in the kind of passive products which we are providing to you. And to add to that kitty of long list of passive products, we are adding this product to our Smart Beta suite of uh, uh, the other products. Today we have Mr. Chintan Haria, who's heading the product development and strategy at ICICI Prudential AMC and is the brains behind launching all of these products. And so today we will hear Mr. Chintan Haria explain this product, what is the idea of launching this product, and why you should consider this product for your investments, and especially right now, because there are some recent developments which have happened. And so, without any further delay, I will hand over the call to Mr. Chintan Haria, who will take over and explain the product, and then we can take the questions also at the end of this call. Thank you.
Sure. Thank you. Thanks, Karan. And just before we speak about the product, I'll probably take up about a couple of minutes in terms of what's happening in the markets and how are we seeing your fellow investors look at the markets. Clearly, the last 7 to 8 months, starting from October 2021, has been a bit of a weak spot in the markets, courtesy two things. One is the inflation, which was caused by all the amount of money that was printed in the prior 2 years, has gone up sharply in the developed markets, especially. And so, if you look at America or UK, Europe, the inflation numbers are at 30-year, 40-year highs. Now, that has obviously meant that your central banks, which were running a very low interest rate environment, interest rates were very low globally, as you would be all aware, are starting to go up. And when these interest rates have started to go up, especially in America, the dollar has also strengthened, which normally causes all your risk assets like equities to come down. So in the last 7 months or so, that is since the beginning of 2022, there has been a synchronized fall across asset classes. We've seen bond markets see a fall. We've seen equity markets falling. And of course, the other alternate markets, which were otherwise popular, have also fallen sharply. This has specifically to do with the fact that over the next 6 months to 12 months, there is an expectation of global growth slowdown. And all of this is internationally linked. And that's where India was facing the challenge in the last 7, 8 months of foreigners selling in India. Now, many people do ask that why are foreigners selling 40,000 crores a month in India if India's next future or next few years are so bright? That's because all the money which foreigners put, they put it in emerging market as a basket. In other words, they do not select India as a choice of investment. They select the emerging market, which includes China, India, South Korea, Taiwan, etc., Thailand. And when they take out money, all the money goes out. So if you see actually right now in India, we are not feeling the pain of either currency going down very sharply, neither are we feeling the pain of inflation, neither are we feeling the pain of equity markets, going down very sharply relative to what has happened in any other country in emerging market. If you are in Hong Kong or Thailand or South Korea, you would have realized the amount of pain that your investments have gone through. But in India, courtesy all of you who have been, showing faith in the Indian markets, the markets have actually not fallen. So every month, if foreigners have sold 40,000 crores, the domestic mutual fund as well as insurance companies have bought close to 30 to 40,000 crores, in some sense counterbalancing and absorbing the entire selling which has happened by foreigners. The good news is in July, the foreign selling has kind of slowed down, which is a positive, and that is why markets are also showing a positive trend. What we expect over the next 5 years or so is that India will be the fastest growing among the top 10 economies. And unlike Europe, where there is a lot of pain, we must remember that money will find its way in those markets which have the strongest fundamentals. And today, if you are in US, you are basically looking at a 2% growth, 9% inflation, and a recession which is staring down. So America is going through its own pain and which is not going to go away so easily. If you are in Europe, and I'm sure many of your friends, colleagues, relatives, or even children may be in Europe, the energy prices there have gone up so much that doing business is difficult. And inflation is definitely hurting the growth prospects of Europe. So Europe is in a very big pain, which essentially leaves Asia as subsequent gainer. And within Asia, of course, with whatever is happening with the energy prices, I think Russia and China are emerging stronger. India, on the other hand, has always been that oasis where our domestic economy is strong. The many sectors that we have, be it auto, technology, FMCG, etc., are doing reasonably well. And India does not have a problem of high energy prices because we are still dependent on coal, and we have, with God's grace, a lot of domestic coal which is available. And our growth prospects are not going to get hampered because of the geopolitical situation which is emerging. If there is a global slowdown leading to a recession, then definitely will be a air pocket in India in terms of the volatility increasing. But like we've seen in the last 7 to 8 months, we've been more than able to absorb the massive selling of foreigners, and hence the next 3 to 4 years looks very interesting from an investment standpoint. In India, we've seen interest rates come down sharply. Many investors, new investors coming to the market. The number of demat accounts has gone from 2 crore to 9 crore. And we do believe that this entire new generation plus the digital age is making people realize the importance of how easy it can be to invest in equity markets. And as long as you invest sensibly in equity markets, you can potentially get the advantage of the long-term gain. With that thought process in mind, we at ICICI Prudential Mutual Fund have been launching a lot of products both on the active side and the passive side to allow you to pick and choose what suits your overall investment profile. So while the asset allocation schemes like the Balance Advantage Fund category have always been our favorites in terms of large money that you should invest, there are certain factoral indices like Karan was mentioning. So we have the entire passive bouquet. Of course, you'll have the Nifty ETF, Sensex ETF, Nifty Next 50, Midcap ETF, etc. You will basically also have the sectors like IT or technology, pharma, auto as options to invest. And along with that, there's this space within the passive investing, which is smart beta, essentially picking up stocks on the basis of a particular price factor. And in the case of the basket which we already have the low vol 30, which is very popular, which is the ICICI Prudential low vol 30 ETF. Along with that, we have the ICICI Prudential Alpha low vol 30. We have the ICICI Prudential Nifty Value 20. And we're very happy to launch, and that's the topic of the discussion today. We're very happy to launch the ICICI Prudential Nifty 200 Momentum 30 ETF. And for those who do not have a demat account or wish to invest through the mutual fund route, we are also happy to launch the ICICI Prudential Nifty 200 Momentum 30 Index Fund. So both the ETF and the index fund launched parallelly. The NFO started on 22nd of July. It'll go on till 2nd of August. And of course, after that, once the allotment is done around 8th of August, then the listing of the ETF units will be done and the repurchase and subscription of the index fund will start subsequently in the next few days. So these are simple index-based products, passive products as we call, and the factor is momentum. Now, what is momentum? As the name suggests, momentum is a price-based factor. So it is generally said that you want to bet on a winning horse, and momentum is nothing but picking those stocks, those 30 stocks out of the top 200 universe, which have showcased the winning ability in the last 6 months and 12 months. So simply put, those stocks which in the last 6 months and 12 months have done exceedingly well and have outperformed, adjusted for their volatility, are picked up as the 30 names which will form part of the momentum index, and that will basically get reflected in your portfolio. Whether you invest in the ETF or the index fund, the portfolio at the back end is mirroring the momentum index. So I'll show you a few slides which will probably make it easier for you to understand the concept of momentum. Now, many people would say, you have said momentum means those stocks which have already done well. But if something has already done well in the past, wouldn't it be late to invest in it, or should we not avoid something which has already done well in the past? Arguably, if you look at the momentum as a factor, it is picking up those stocks which are showing momentum, and the moment the momentum, in other words, if the momentum is lost, so these 30 stocks carry for 6 months. At the end of 6 months, that is in June and December every month, there is a rebalance which takes place. The rules or the methodology of calculation is again run, and if a couple of stocks, or maybe say 5 7 stocks, end up losing momentum or are on the weaker side, and something else is on the stronger side in terms of momentum, that rebalancing will take place. So it's not that we've picked up these 30 stocks and these 30 stocks will remain same forever. Every 6 months, the calculation is taken care of by the index provider on what are the best 30 stocks in terms of last 6 months and 12 months price performance adjusted for volatility. And once these winners are picked up every 6 months, there are certain rules and regulations around it, which are nuances, and I will not go in detail right now. But these 30 stocks every 6 months, and if you look at the slide in front of you, if you see the entry point, then you run the momentum for a 6 months to 12 months. And if I have to give you examples, look back and see 2010 to 2015. The pharma index did exceedingly well. Pharmaceutical sector was one of the best performing sectors between 2010 and 15. So momentum in sectors lasts for 3 years, 4 years sometimes. If you look at auto between 2013 and 17 had a great time, but 17 it turned, and 17 to 21 auto has been a completely washout in terms of a sector. 2020 March to 2021 March, pharmaceutical as a sector was the best performing sector, not surprisingly, because of the COVID outbreak. And now we are seeing the auto sector kind of gain momentum. So it is sector agnostic, it is purely on the basis of price. And if you see, you enter as shown in the graph in front of you, you ride the rally in those 30 stocks. Then if something loses momentum, some stocks lose momentum, they will go away. The stocks which are gaining momentum will again come in. And through this process continuously over 6 months, we've seen, and I'll show you a few data points, in the long run, the performance has been supported well for this particular index. So what is this particular index? In very simple terms, it captures the top 30 names on the basis of past 6 months, 12 months performance, price performance. And there are inbuilt risk measures as part of the safety net that you need when you're investing in a portfolio of diversified stocks on the basis of momentum. First is that no single stock will have a more than 5% weight in the index at the time of rebalancing. Also, if it's a stock which is very small, then it will not have a weight of more than 5 times its smaller weight in a free float market cap environment. So that is basically a risk measure which ensures that no single stock becomes so large that it can hurt your performance in a negative way. And all the stocks which are part of the 30 which are going to be selected for the index are part of the futures and options market, the derivatives market. So their liquidity is also very strong. So when we are launching a product, we have to be cognizant of the fact that we are able to scale it up, we are able to replicate the product, and since it can be a 5,000 crore, 10,000 crore product at some point of time, we should be able to rebalance it with the minimum impact cost or efficient impact cost, as I can say, so that these measures become extremely important. It is top 200 names, which generally are the most liquid names in India. Within that, it is only the derivative names, which makes it very easy. And because there's a 5% capping on a single stock, the impact costs on entry and exit at the time of rebalance is also reasonably well managed. The stock must have a 1 year listing history, so a IPO cannot suddenly start coming into the portfolio. That is also a good thing because you need a history of listing before the stock can be part of the index. So this is basically the stock selection criteria, which I've already explained, but just to reiterate, out of the top 200 names, which is a Nifty 200, 30 stocks are selected on the basis of their price performance. Once those stocks are selected on the basis of their price performance, their weightages are on the basis of their price performance, which is called the momentum score, and their market capitalization, so that there is some element of weightage that is given to a stock because it is large. So a large stock given momentum, it's basically having a higher weight, which is obviously good from an investor standpoint. Index is rebalanced every June and December basis the prices of May 31st and November 30th. If you look at the portfolio, you will again appreciate the fact that on valuations, it is similar to Nifty 50, that is a broad market index. On top 10 holdings, if we see, it is again something which you intuitively will be very comfortable with. Reliance Industries, NTPC, ONGC, ITC, Mahindra & Mahindra, Adani, Power Grid, Bharti, Sun Pharma, Tata Motors. These are picked up purely on the basis of their past performance being good relative to the other stocks, and their weightages are also kept at 5%. So effectively what we are seeing is that there's no sector bias coming in. Whatever is doing well across sectors is coming up, and their weightage is being a factor of momentum score and market cap. It is a brilliant mix ultimately which you are getting. So it is a diversification of portfolio. At the same time, it does the job of actually giving returns. And if I look at from a sectoral standpoint, the broad market indices have more than 30% in financial services, but this index is purely on the basis of price performance. So if we do find some sector likely to do well in terms of past performance, having done well, and it will end up basis the past performance being well, having a higher weight. Currently, it is well diversified across the board, and the sectors which have the highest weight are power, oil and gas, capital goods, and auto. Not surprising, but how many funds will you find which will have a portfolio which will be high in power, oil and gas, capital goods, and automobiles, which is what makes this particular product unique. Because today it will have power, automobiles, capital goods. If you went back maybe in March 2020, because between March 2020 and June 2020, the healthcare sector, after COVID outbreak, the pharma stocks did exceedingly well, we all will agree. They became the flavor of the season, and this can be shown in this slide. If you look at the leftmost bar graphs which are there, in July 2020, almost 32% of the index was in pharmaceutical sector. Okay, and that was the beauty of this particular product, that how many funds would have been able to actively pick 30% in pharmaceutical sector. This product is only looking at price performance, right? And based on price performance at that point of time, pharmaceuticals and FMCG stocks looked the strongest, and that is what got reflected. If you look at auto was very low. Almost no auto stock was there till June, July 2022. And suddenly in July 22, because the auto stock started to outperform over the last 6 months, the weightage has gone to 10%. So it is a very beautiful self-balancing mechanism in favor of the winning sectors, which is happening in this fund, and which is what is leading to the kind of outperformance that you see in the long run. So don't think of it as a quick in out, quick profit making ability which are there, because momentum by itself will sound okay, let's catch the momentum and let's get off the train. That's not how it is. You can actually stay invested for the long run, and if you see the blue line over the pink line or the orange line, it showcases how over a long period of time the index has been able to deliver outperformance. And this is again aptly replicated in the index performance. This is the actual index performance over the last 12 calendar years or 11 calendar years, and 8 out of the 10 11 calendar years the index has outperformed, which are already shaded. And more importantly, if you see, we invest in equity markets so that when the uptick comes, we are able to capture the uptick, And when the downside comes, you don't fall abnormally unless you capture the upside abnormally. And that's where, by definition, momentum, as it sounds, it is going to be a bit more volatile, no doubt about it. It may seem a bit more risky. But if you look at the numbers, look at 2012, the kind of outperformance that this particular index has brought in. If you look at 2012, um, just a minute. If you look at 2012, the Nifty 29%, momentum index 38%. 2014, when the NDA government came into power for the first time, 32% in Nifty, 50% in 2014 in no momentum index. 2017, all of you would remember, was one of the best years, after which we went into a 2 to 3 year correction phase. 30% on the Nifty, 58% on the momentum index. So we got such outperformance in the past 5 years that in 2018, when the markets kind of mellowed down or turned around, instead of getting a 4% in Nifty, you have got a -2. But the -2 can be easily digested with the kind of outperformance that you've seen in the previous 3 4 years. It's massive, including a year like 2015, where Nifty was -3, but the momentum index, courtesy it being in the right stocks, ended up giving a positive 11% return. So if we look at it in terms of the past, there is some mechanism by which, when you bet on winners, you are able to get, in the long run, a better experience in terms of returns. Now, if you look at 2021, clearly one of the best years, 25% versus 53%. And hence, because the returns in 2021 were so good, the market has changed direction in the last 7 months. And it is providing us an opportunity to start adding on to this particular style, adding on this particular smart beta factor. -21% versus -8% on Nifty in 2022 is understandable. The underperformance is understandable because the market has changed direction in 2022. Every time the market will change direction, the strategy may underperform. But but the important aspect is, in the last 10 years, in terms of empirical evidence of the index returns that is there in front of us, every time markets have gone up, and if you've been in the right momentum stocks or the right stocks, or you bet on the winning horse, as they say, or you basically invested in this momentum based selected 30 names, you've been able to capture not just the upside, but actually a lot more than that, which has helped the long term returns be very good. Um, Again, if you look at 3 year rolling return, 5 year rolling return versus 11% on Nifty, which you would have got anytime. So, anytime in the last 13 years you invested in this particular product, the average returns have been better than Nifty. Standard deviations and risk adjusted return have also been competitive. In other words, yes, there may be higher risk that is there, probably because these are stocks which are moving faster, but and they can, if the market turns, you can lose as well. But in general, over the last 11 years, the experience has suggested that that extra return which is generated by these set of 30 stocks more than makes up for that extra risk. And to that extent, we are very happy to launch both the ETF and the index fund. And if you look at from a experience standpoint, uh, we do believe that this particular this particular ETF and index fund does provide a good opportunity for investors to participate in winning stocks which are chosen with a methodology which is already well established, globally accepted principles in terms of what should be considered as momentum and how it should be calculated is incorporated in the methodology, and the past returns, or if you look at every calendar year, will showcase what to expect from this product. You can expect outperformance when the market is doing well. You can expect when the market turns, there's a bit of underperformance which will happen. But if you keep your money for 3 years, 5 years in this portfolio and longer, there is a probability that this index will probably end up giving you that kicker which you need in terms of the momentum of your overall portfolio wealth creation. With that, I will stop. Uh, in the ETF itself, the minimum investment is 1,000. In the index fund, the minimum investment I think is 5,000, and the index and the ETF NFO closes on 2nd of August. We look forward to your support. Treat this as, of course, your equity allocation. This is going to be fully invested at all points of time, it being a passive fund. Our endeavor has always been to have it as low cost as possible and allow investors to track the index as closely as possible, which in other words means the tracking error, etc., has to be very low. And we also endeavor that on the exchanges, etc., the liquidities which is there is always provided through the authorized participant, and investors can actually invest or take out money on the exchanges in a smooth and efficient manner, close to the price at which the underlying NAV is traded. With that, I will stop and will be happy to answer questions. Thank you. If there are any questions, participants can put them in the question box which is there, and I'll be happy to answer. Thank you. Just in case if there are no questions, you're most welcome to basically reach out to your respective connect at HDFC, and we'll be able to answer through them any queries relating to the product which we have or any of the other products. Karan, over to you. Thank you.
Sure, Chintan. Thank you so much, first of all, for this detailed explanation on the product. Uh, just a personal question which I wanted to ask, Chintan, is that you very well highlighted that, what has been the track record of this factor. Uh, However, given the rebalancing which happens in this portfolio, uh, the recent rebalancing has actually made this portfolio quite cheap. If you compare it with the earlier valuations. So, would it be a good time? Is timing also a factor which can also help investors to sort of book good returns in this sort of a product?
Sure. So as you can see in front of you in terms of timing, uh, generally it is said that if something is underperforming, it is a good time to start investing in it and make money out of it. So currently, obviously, the index is underperforming Nifty because the previous 2 years were splendid from an index standpoint. But I don't think in this particular product you have to bother too much about the timing. All you need to know is that treat it as a treat it as a 3 to 5 year view. And if you, and to your point, which you asked in terms of the valuations, uh, if you see from October 2020 and more so in the last 7 to 8 months, the value stocks or the stocks which had underperformed significantly have started to outperform, and the old economy stocks or the value stocks with high dividend yield are kind of coming, making a comeback. And that's where if you find on an overall basis, the entry of those stocks and the exit of maybe the expensive names like in the technology sector has meant that this index in terms of valuation also starts looking interesting and attractive. So I think the beauty of this product is that it is a purely price-based selection of stocks. It is not subservient to only value as a theme or growth as a theme or quality at any price theme. Basically, whatever will work will be part of this index. And hence, from an empirical evidence point of view, both globally and in India, the top performing smart beta factor has been momentum, I think, followed by low volatility. So we launched low volatility 5 years back, and we are very happy to launch the momentum as a factor because it's something which has this ability to auto-correct itself in terms of being in the right space at the right time. And that's generally what happens, right? When we all invest or we all want to invest in businesses or otherwise, we want to invest in something which is doing well and is likely to do well. And if the recent past has been good and the momentum continues, you end up getting the benefit of that. Plus, it is very important and which is very difficult as human beings, that if something has gone wrong or some stock starts to fall very sharply, you're not able to exit it when the turn happens. And this particular product, because of its very nature of buying those stocks or being invested in those stocks which are showing upward price momentum relative to the other stocks, if something loses momentum or something loses relative price momentum with the other stocks, that will automatically go out. So you will enter the pharma stocks at the right time, and when pharma starts to lose momentum relative to, let's say, auto, auto will come in, pharma will go out. It's a beautiful way to address many of the greed and fear factors which otherwise impact a fund manager from buying and selling in the right sectors at the right time. Of course, like I said, whenever the markets turn like 2022, there is going to be a bit of underperformance, which is possible because when it does very well in 2021 or in 2014 or in 2017, the momentum stocks rise very sharply, and when the turn happens, they tend to see obviously a bit of a fall, which is more than market. But if you can see the last 10 years cumulatively versus a 11% Nifty return, if you can see an 18% Nifty return, that's quite a sizable outperformance in the longer run. So don't treat it as a trading vehicle. If you want to, it's fine. But if you treat it as an investment vehicle, the momentum index is a great tool for those who are looking to participate in the winners of the recent past. Thank you.
Thanks, Chintan.
So I see a few questions in the chat box. I'm just trying to expand it. There's one question, will this presentation be shared? So we'll be very happy to share the presentation with you. And Karan, please, if you can enable that through the help of the HDFC team. Mr. Varun Sheth is asking, what is the, just a minute. What is the main difference between your ETF and the index fund? All right. So thanks, Varun, for asking that question. Both ETF and index fund are meant to track the index, but their vehicle is slightly different. And what are the differences? I'll just quickly touch upon that. When you invest in an ETF, you basically are buying and selling on the exchange. The portfolio at the back end remains the same. So, in other words, it is the same portfolio which will be there in the index fund. So, index fund and the ETF will have the same portfolio at the back end, as in they'll mimic the same index. But what is the difference is that the ETF will have its units listed on the exchange, so you can, on a real-time basis, suppose markets are down 4% and you want to take advantage of that, you can do that in an ETF. If the markets are up 4% and you want to sell for some reason, you can do that. That's the biggest advantage of ETFs, where you get real-time entry and exit, and you can buy as low as one unit, which could be 30 rupees, 40 rupees, 50 rupees, 100 rupees, depending on the each ETF. In the case of index fund, you have to come to the AMC in the case of normal business for basically subscription or redemption. You can do it through the digital route, online route, etc., on the website of HDFC Security. And your money or your money will come into the fund and you will get the NAV of the day end. In other words, whatever is the price as on the closing day on the date of investment that you do, that is the number of units based on that price is what you will get. And similarly, when you redeem from the index fund, the day end price will basically be provided to you and you will get the money in T+3 or as the case may be in terms of the settlement cycle. In the case of exchange, it is like buying and selling of a stock. And I think the T+2 settlement cycle works in the case of exchange. So ETF and index fund are simply two similar vehicles, just that the execution is slightly different. In the case of ETF, you need a demat and a trading account. And much like how you buy a share or sell a share, you can buy a single unit of the ETF also. So sometimes it becomes easier for you to, even if you have smaller savings, to start participating. In the case of index fund also, while the minimum threshold size are normally low, you will still need to probably come to the AMC and invest. It's easy, but that's how it is. You don't get the benefit of real-time NAVs in the case of index funds. But if you want to do SIPs, etc., it's easier to do with an index fund. There is a facility for that. You can do probably systematically buy on the units on the exchange as well. But I think most people who don't have a demat account prefer the index route. If you have a demat account, you can go for the ETF route. That's the major difference. Otherwise, there may not be much difference. There may be a certain difference in the expense ratios of the two products, but apart from that, both the products are basically replicate the index itself. The next question is, can we sell this anytime like stocks? Yes. If you buy any ETF, not just this momentum ETF, if you buy any ETF, much like how you can buy and sell a stock anytime, you can basically buy and sell an ETF also anytime, whenever the markets are on. As this is new NFO, the question is, what NAV these funds begin at? So in the case of the index fund, the NAV will be 10, but in the case of ETF, it will be, I think, 100th of the price of the index or 1,000th of the price of the index. So in the case of the ETF, the price will be determined by what is the index value, while in the case of the index fund, it will start at the NAV of 10, or the allotment will be at the NAV of 10. The price or the allotment price or the ETF price does not necessarily matter in terms of the returns. The returns are obviously linked to how the index performs, and that will get reflected either in the ETF or the index fund, as the case may be. The presentation will be shared. Yes, we'll be happy to share the presentation. What is the cost of exiting the fund? Yeah, so in the case of exit loads in ETF, there are no exit loads. In the index funds also, as a normal policy, there may not be any exit loads, but this is subject to change. So you can check on the website. Generally, there are no exit loads on index funds. You can exit without any loads in the case of index funds. But some index funds may have exit loads. In the case of most index funds, there are no exit loads, and you can exit without a worry. In ETFs, there is no concept of exit load. I think most of the questions have been answered. So thanks a lot for those questions, and thanks for sparing your valuable time. If there are any further questions, we'll be happy to answer them through your contact in HDFC. Thanks a lot. Karan, over to you.
Thanks a lot, Chintan, and thanks a lot all the participants for joining this call. As Chintan mentioned, see, this fund is these are smart beta funds. So smart beta funds are gaining a lot of popularity amongst investors. We would urge that you explore more about this product and choose to invest, because smart beta funds are a very cheap way of investing. First of all, they are low cost if you compare them with active funds. And if you see the performance of these funds also, see, I mean, the underlying philosophy of investment is could be compared to active investing also, where you have a fund manager. Here we are, obviously, there are set of rules, and as per those rules, these stocks are selected. But ultimately, it has been delivering good performance, and that has been it is evident in the data which we have shared with you today. So we would urge you to look at smart beta funds. We would be running the ETF at 0.30% of expense ratio. That is a very, very low expense ratio for the ETF, and even the index fund would be under 1%. So the the cost of these funds are also very low, which means that the cost does not eat into your performance. It does not get compounded with the number of years you are invested, and that helps to give the best performance ultimately delivered to you. So yes, the NFO is going on. It is available at the HDFC Securities portal, on the website, or on the application, and you can invest into this product till the 2nd of August. So thank you again, all the viewers. We hope to see you soon. Thank you, Chintan, once again.
Thanks a lot, everyone. Have a nice day. Thank you.